You know, on the surface, the US economy might look like it's doing just fine. But if you start to look a little closer, behind the headlines, there's this growing fear, a sense that the jobs market is teetering on the edge of a cliff. So what's really going on?
So, what's with all the anxiety? I mean, it's not just a vague feeling in the air. We're talking about bosses, major investors, and even the top policymakers in the country. They're all looking at the same data, and, well, they're getting pretty worried. There's this widespread feeling that something is just fundamentally off, even if the big numbers you see on the news don't always show it.
Okay, here it is. This is the key phrase you really need to understand to get what's happening: the K-shaped economy. It's what all the investors and analysts are buzzing about, and honestly, it perfectly captures the split that we're seeing. But what on earth does that actually mean?
Right. So what does this whole K-shaped divide actually look like in the real world? Let's break down the evidence.
At its absolute core, it's about a split. Just picture the letter K in your mind. You've got one arm shooting straight up, right? But then the other leg is pointing sharply down. Well, that's a pretty good picture of the US economy right now. It isn't one single story anymore. It's two totally different stories happening at the exact same time. And this slide just lays it out perfectly. On one side, the arm going up, you've got the stock market doing incredibly well, just absolutely roaring, fueled by these huge investments in new tech, like artificial intelligence. But then you have the other side, the leg going down, the side that most people actually live on. And there, the jobs market is getting weaker, and ordinary Americans are really feeling left behind. Now, this is really interesting, because this points to a major red flag for economists. See, normally when the economy grows, it creates jobs. Those two things are supposed to move in lockstep, they go hand in hand. But right now, they've split apart. The overall economy is still growing, but that growth just isn't creating new jobs the way it's supposed to. And that kind of divergence, that's a serious, serious warning sign. So with all these warning lights flashing red, who do we turn to? Well, all eyes are on the US Federal Reserve. Let's take a look at their official response to all of this.
So the Fed, they've definitely seen these warning signs, and they're not just sitting on their hands. They're already taking action. They've cut interest rates at their last two meetings, and that's their number one tool to try and prop up the job market before a real crisis hits.
And here's the thinking behind it, coming straight from the Fed's chair, Jerome Powell. He's calling these cuts risk management. So think of it less like they're hitting the big red panic button and more like they're taking out an insurance policy. The idea is to spend a little now to try and prevent a much, much bigger disaster down the road.
When you break it down, the Fed's logic here is pretty straightforward. Step 1, you spot the early warning signs of a weakening job market. Check. Step 2, you cut interest rates as a form of insurance. Check. And step 3, you cross your fingers and hope that this is enough to stop a full-blown, much deeper economic downturn.
But, and believe me, this is a really big but, not everyone agrees that this insurance policy is the right move, or if it's even going to be enough. In fact, right now, inside the Federal Reserve itself, a really high-stakes debate is raging about what to do next. And here are the two sides of that debate. On one hand, you've got the current chair, Jerome Powell. He favors this cautious, step-by-step risk management approach. But on the other hand, you've got Christopher Waller, a potential successor, and he's arguing they need to be way more aggressive. He's pushing for more rate cuts, and he wants them faster to really get ahead of the problem. And this isn't just some small technical disagreement, it's a fundamental conflict over how to steer the entire economy away from that cliff edge.
And this whole thing is about to come to a head really soon. I mean, the debate is happening as we speak, but the big decision comes on December 10th. Are they going to follow Powell's cautious path, or will they go with Waller's more aggressive one? The crazy part is we won't even know for sure if it worked until the first real data starts rolling in early next year.
So, let's pull all this together. Where does this whole situation leave us? Is the US jobs market really on the edge of a cliff? Or is there a path back to safety? All right, let's just recap everything in a nutshell. First, the worry is real and it's widespread. Second, the core of the problem is this K-shaped economy, the split where the top is booming while the jobs market for most people is actually getting weaker. Third, the Fed's response is this insurance policy of cutting interest rates. And finally, there's a serious conflict brewing inside the Fed over whether that policy is anywhere near aggressive enough. And that leaves us with the one big multi-trillion-dollar unanswered question. Is this insurance policy from the Fed really going to be enough to pull the economy back from that cliff's edge?
All eyes are going to be on that December 10th meeting. The decision they make could determine whether this insurance policy pays off or whether the U.S. jobs market takes a step right off that cliff.